This is the CRE Weekly Digest by Lightbox, a data and technology firm for the commercial real estate market. I'm Martha Kocher with Manus Clancy, Head of Data Strategy, and Diane Crocker, Research Director. It's a short trading week with the 4th of July holiday, so this week's news has been largely connecting employment data reports with Powell's comments that we're making disinflationary progress, but as he said, policymakers need to see more before any rate cuts. And this week, listeners are going to get a sneak peek at the Lightbox CRE Activity Index that will be released next week. Let's jump right into that. Diane, what does June's number reveal about transaction velocity for last month?
Thanks, Martha. Hi, Manus. Before I share the June number, for those listeners who haven't heard our first podcast, the Lightbox CRE Activity Index is an aggregation of daily transactions across the Lightbox network. So this monthly number, which is the aggregate score, essentially measures relative changes in the velocity of property listings, of valuations, and environmental due diligence, all aggregated and indexed to a 2021 baseline of 100. So in December of last year, the year kind of ended with a sputter. We were at a 3-year low of 45.7. It rebounded in January, only to fall in February. So if you saw our latest May index, you know that it was, as Martha said, 91.1. That was the third consecutive month of modest increases. So we were excited to see what June said. I just ran the numbers yesterday. I'm sorry to say it was not the fourth consecutive month of upticks. June's aggregate index is 89.2. It is a modest 2% below May. I don't really think the market was that different in June than May, quite honestly. You know, my teen daughter listens to Olivia Rodrigo. It's not exactly my flavor of music, but the first thing that popped in my head when I looked at the June index were the lyrics to her song, "One Step Forward, 3 Steps Back." I think we're not taking 3 steps back. It's just a smidge below May and pretty even with April, pretty even with June of last year, right after we had bank failures. So I think, flat is the new good. Manus, what do you think of June coming in a little bit below May? Is that surprising?
Well, my first take is I'd like to have a podcast devoted to nothing but your musical taste. I think once we establish, a real sizable audience and we need a week break, I want to hear, what you're listening other than Olivia Rodrigo. I feel good about where we are. Do I feel great? No. I feel like the summer could be choppy only because velocity picks up and slows down because of vacations and 4th of July. And historically, deals that you think might get done in August get pushed to Labor Day and so forth. And that could be the noise here. June is a slightly shorter month than May. We also had Juneteenth in the middle of the month, which was a midweek holiday. So it doesn't really surprise me that we've leveled off a little bit. My narrative, at least, is based on the number of bidders we're seeing for unloved properties, based on the fact that loans are selling. Banks are able to find buyers for loans that they're trying to get off their books as they de-lever CRE. The fact that portfolio deals are getting done by a variety of buyers across a large segment of property types tells me that this is a market that's functioning and will continue to be on the uptick for the rest of the year. And that's my hot take on this. I tend to run glass half full, as the audience knows. That's where I think we're headed.
Yeah, I'll add to that, Manus, that I did touch base this week with a few leaders in environmental consulting, and you mentioned portfolios, and I heard from a few that they've already seen a few big portfolios come in just in the past couple of weeks. So I think that lends some credibility to your forecast. We'll see what July brings in and if we're able to beat 89.2 by the end of the month.
Yeah, I know you had forecast that the progress was going to be choppy in the second half of the year, and obviously that has come to pass. So what do you think is going to account for the rest of the year?
Martha, I think, really the Federal Reserve kind of has the market by its heel. So before we see any meaningful growth in lending and investment, I think the market really needs that psychological impact of the first rate cut. So any forecast we do has to build in what I see as a very much unlikely scenario where there's 1 or 2 rate cuts this year. And those were taken as a given back in January when everybody thought we would see 6. I told you both recently that I was voted class optimist in my 8th grade class. So like Manus, I do tend to trend toward glass half full. But when I think about the forecast, I think there are headwinds that we can't ignore. With rates not moving, borrowed capital is going to be challenged. cash is obviously king. But the other elephant in the room is we're approaching a divisive presidential election. So when we do the forecast, I think we have to assume that there's going to be a late Q3, early Q4 kind of tapping of the brakes, and the revised index forecast is going to reflect that.
You mentioned that last week, and I think that that's right, that we will continue to see some uncertainty as we march towards this election. It was a very strange week. Martha kind of hinted at this in the beginning. We were short on data, not a lot of data that came out this week. The only thing we got just a few minutes ago was ADP, where their jobs number came in just a smidge below expectations. But the odd thing this week was that we saw at the very end of last week and the beginning of this week a real spike in Treasury yields. We saw the 10-year yield jump from, I would say, about 425, 428 up to almost 450 without any economic news. And people were attributing it to what you were saying, uncertainty with the election, people focusing on the deficits, the size of the U.S. debt, and what that would mean. And to that, I would add that we also have elections going on in France, things coming up in the UK as well. So I think that this bumpiness will probably not be limited to just the US. I think that investors will react to other election results as well. The thing that I thought was a bit crazy about the spike in interest rates this week was that after the debate, people started focusing on the US elections and the debt and so forth. And from my perspective, it's one of the only things that Biden and Trump agree on is that we are going to spend like drunken sailors no matter what. And for people to focus on that after the debate kind of seemed a little crazy, right? This has been a problem for a long time, and why it bubbled up and why it pushed rates higher this week kind of was a little nonsensical to me. But higher interest rates early in the week, they did retreat a little bit today after ADP back to 440 on the 10-year. So, the hope is that trend that started in April where rates were kind of grinding lower month after month will continue over the summer. That would give buyers and sellers some relief.
Yeah, you might be right. And I think the other point on the tailwind side is we're an impatient market, and nobody wants to be late to the party or miss out on opportunities. So that's why I think the transactions that you highlighted in our last podcast and that we'll do here, show that folks are moving in, they're getting deals done. And I think the more that happens, it's going to fuel a sense to other investors like, hey, it's okay to come in the water, and chase deals again at prices that they might not see for a long time.
If you want a copy of the Activity Index report, our customers get a copy regularly, but if you'd like one, you can email us at podcast@lightbox.com. We'll be happy to send that to you. Turning to the big picture, we saw some analysis from two industry titans that provide some color that deserve attention and some continued challenges in the subsector of retail.
So the first one in the big picture comes from Bob Knackel. For those that don't know him, he is really a legendary sales broker in Manhattan. If I'm not mistaken, I believe it's $20 billion or is it $200 billion? It's some extraordinary number over the last 20 years of sales in Manhattan that he's brokered. He's very active on Twitter. He's a great follow. He had his own firm, sold it about 10 years ago for $100 million. Just a real thought leader in the market. Over the last couple of years when we had COVID, he literally walked Manhattan to create a map of Manhattan to figure out where all the undeveloped space was. And he has this map room. If you're lucky enough to know Bob and can get an invite into the map room to see what he's put together, it's just really something else. I haven't been there yet, but I've said before that the map room is to CRE types what Studio 54 was to celebrity figures in the late 1970s, right?
Yeah.
There was the velvet rope, and if you can get in there, it was the pinnacle of the disco era. If you get into the map room and see what Bob has done, it's the pinnacle of CRE. So why am I bringing this up today? Bob is very data-driven, data-intensive, and he put out a couple of statistics that I thought were really, really interesting. He pointed out that of the hundreds of millions of square feet available in Manhattan and the number of properties that are out there, historically, we see about 1% to 2% of those turnover each year. So it's not a tremendous amount of properties turning over. In a really, really great year, maybe you'll see 3 or 4%. And now what he's predicting, because we're seeing this change in Class B and Class C offices, he's expecting turnover to hit 5%, which he thinks will be an extraordinary number, an all-time high. And what it means is that there'll be capitulation on the side of people that are owning these properties that see no upside, but there will be people rushing into this market to reposition these, to pour capital in, maybe transition them from office to residential. So that 5% number was really eye-opening. The even more eye-opening number was he expects in the Class B and Class C segment that 50% of all properties in those classes will have new owners within 3 or 4 years. Imagine that 50% of the inventory of Class B and Class C offices will turn over. What does that tell me, and where does that take me? Where I'm going is this office repositioning is going to be very short. That if people think that there's going to be another 2 or 3 legs down and that they have 2 or 3 years to wait for bottom to hit, I think they're fooling themselves. I think we're getting very, very close to that bottom. We're seeing a bottom form in places like Los Angeles, Portland, San Francisco, Chicago. And I think that when you see these sales taking place, even though they're 70% off, 65% off the values from 2015, these sales are said to be getting 30 or 40 bidders per opportunity, which means that people are circling right now. And I do think my takeaway from this is if you think it's close to the time to deploy, you're probably right. It's time to really start sharpening that pencil and getting ready to deploy capital because this opportunity won't last forever. Diane, what do you think of that?
I agree. And first of all, I second your mention of Bob. He's a fabulous follow on LinkedIn and Twitter and tells great stories about getting deals done. And if you get inside that map room, I will be extremely jealous. While we were baking bread or painting the inside of our houses during the pandemic, Bob was walking Manhattan with a Sanborn map, creating this amazing inventory of properties and developers. So I second that. I think that stat about 50% or more buildings changing hands is certainly one that gets attention. And that I think is what's going to fuel that kind of FOMO sense by investors that, look, we better jump in or the window's going to close and we're going to miss out. So that's definitely, I think, the biggest tailwind that's pushing the market right now. And there will be losses. And that's, to the point that you made earlier, this is just in New York City. This trend will likely happen in other metros across the U.S. too. And that's going to be, I think, a big part of the story in the second half as we see these assets change hands.
One more point about Bob, and then one other data point that I'll throw out there, or one more news article. For people that are young out there that are listening and are just getting into the market, there's 2 or 3 great follows on Twitter. One is Strip Mall Guy, everything about retail, especially small retail. You can learn so much from him following on Twitter if you just follow what he puts out there. In the New York City space, in property redevelopment, in understanding how properties can be used for alternative purposes, nobody better than Bob. The number of things you can learn over the course of the week is just extraordinary. And so for young people out there, I would follow him. He's just a wealth of knowledge. On the news side, the other thing, this came from Globe Street this week. Goldman Sachs made the call that offices have hit bottom. Now it's time to deploy capital. When precisely we hit bottom is subject to debate. You only know it historically. But I agree with them. I think that we are getting very, very close in most markets to finding capitulation and hitting that bottom. And I think that while it may not mean a V-shaped or a U-shaped recovery anytime soon, it probably does mean that prices are not going much lower anytime soon.
And man, it's just a fact check on Bob Knackel's stats. He's apparently specifically brokered the sale of more than 2,300 properties in New York City with an accumulated value of approximately $21 billion or $22 billion, depending on how you count it.
Okay, so my first guess was not terrible, right? But then again, I didn't take my socks off. I was only counting on my fingers.
All right, so the second big picture item that you wanted to cover was research that was looked at by Alan Todd at the Bank of America team.
Yes, Alan Todd has been a researcher for CRE and CMBS for a long time, often is considered in the polling that investors do the top of the industry or close to the top of the industry. There's votes every year that talk about who puts out the best research. And, it's kind of like the Major League All-Star game. Fans vote on it. And, just like the late Willie Mays was always at the top of the list, Alan Todd is always at or near the top of the list as well. He put out research which I found really compelling. We talk about the wall of maturities and how many loans need refinancing and so forth. with. And he put out a statistic. You could see it on Twitter. I'm not at liberty to share his research per se, but it is on Twitter if you look for it. And if you actually reach out to us, we'll tell you exactly where to find it on Twitter. But he said of all loans that reach their maturity date in the first half of 2024, 2/3 have been able to get taken out, which is a nice number, right? 2/3 are finding their way to muddle through either through refinancing or cash in or friends and family. If you take out office, which is obviously struggling mightily, that number jumps to 75%. And if you only look at loans of a certain size, if you're not looking at the real mega loans, the number jumps even higher. I believe it's over 80%. So that runs contrary to this narrative that nobody can find refinancing, nobody's lending, everything is extend and pretend. And when you think about the smaller loans finding a greater likelihood of muddling through, in many ways, that's what the banks own. People are worried about banks, bank failures, bank losses. Banks generally don't traffic in that $100 million, $200 million, $300 million loan. They're funding their local guy, grocery anchored, small office, things like that. And the fact that those are paying off at a higher level is definitely a promising sign. If you're a client of Bank of America, I'm sure you can get the research directly from them, but well done by Alan Todd.
And the last big picture story was one that we've seen in the last week or so, but it's actually something that's been playing out over the last several years, and Diane's going to give us a little context there.
So what happened was Walgreens announced plans to close a substantial number of its underperforming stores in the U.S. over the next 3 years. One thing that really jumped out at me was this headline that characterized it as a brick and mortar downfall. And I don't want to downplay what's going to be a significant downsizing by a major pharmacy, but the words brick and mortar collapse kind of hit a nerve with me. I've read that spending on health and beauty products is way down. Maybe that's due to the work from home trend. Who knows? But, Walgreens is going to right size to a new environment. But I certainly don't think that retail is in this free fall. It made me think when Bed Bath & Beyond closed something like, almost 400 stores last year, including one in my town, before I could miss those big coupons that we always got in the mailbox that Bed Bath & Beyond is known for, this shiny new furniture store appeared in its place. And the rumor in town was that Trader Joe's was second in line if the deal fell through. And I have no doubt that stronger retailers are going to jump in and fill these store locations that get vacated by Walgreens. I read last week, vacancy rates in retail are at historic lows. And investors who really have done zero deals in retail for more than a decade or ever are starting to jump in and look at investment opportunities in retail. So when I saw that headline, Martha, about Walgreens, it really kind of made me bristle a little bit.
The retail story is, there's several tentacles to what you were saying, Diane. The most blunt is we are certainly over-pharmacied in this country. Every street corner once had 4 gas stations, but now seems like every corner has at least 2 pharmacies and somebody else who's also selling pharmaceuticals like a Target or something like that. So it's certainly that needs a reset, no doubt. With regard to this particular story, the real rubber hitting the road for retail was 2017 to 2020, where we saw hundreds and hundreds of retailers file either Chapter 11 or Chapter 7. Toys R Us, Sports Authority, Sears, even JCPenney, even though that came with enormous store closings. And yet, aside from the malls, retail did terrific. Strip malls, shopping centers, grocery anchored, all of those segments of the market did really well with very few defaults, very small numbers of losses. The malls were a different story, but even with the malls, that took years and years to play out before the losses of tenants became so big that borrowers ended up throwing back the keys. So as I've said before in the past, if you survived the retail downturn of 2017 to 2020, you probably won't see anything worse. And if we survived that as an industry, chances are we could survive anything. So I feel like you do, that this isn't the end of the world.
Let's quickly move to 3 things that caught our eye, and that's going to take us to a couple stories that are scaling down coal for cash and a reset.
So the first one here, we talked about this last week, I believe, that Washington Federal sold off $2.8 billion worth of loans. I think 2.9 is actually the right number. A few weeks ago to Bank of America. Our point at the time was that banks that are selling loans are finding buyers. It's not one of these things that the FDIC is the buyer of last resort. We saw CIBC sell some loans as well. We saw JP Morgan acquire assets from Signature Bank. So banks selling loans are finding buyers for these things. And when you talk about something as big as the Washington Federal portfolio, where you're talking about 2,000 multifamily loans, that's a big number. This week, Erica Morphy of Globe Street reported the sales price of this. 92 cents on the dollar seems to be the price that they got for this. Another positive sign, right? 92 cents on the dollar probably reflects nothing more than the mark to market that they're selling loans that were made in a 3% treasury market, now in a 4% treasury market at a discount of 8%. We would be very concerned if we said these things were selling at 75 cents or 65 cents or 55 cents. 92 cents on the dollar is really a mark-to-market level, and it's evidence that people are willing to pay for these things and pay firm prices, and I think that's a great thing. And by the way, at the same time, their CEO, Brent Bairdell, pointed out that CRE fear is way overblown. He says these are good-performing markets, good-performing loans, and good on them for getting a nice price there. This second one has a little nuance to it, and maybe I'll call upon our listeners to reach out to us and tell us what I think. This is about cold storage, and it's a market that I can't say I know particularly well. It's a little bit of a blind spot for me. The story is that Global Net Lease has sold a cold storage portfolio to Americold, $170 million. What really caught my attention here is that the cap rate on this 9-building portfolio was nearly 8%, 7.88%. So I had to go out to my guys and say, I'm a little shocked at this. Industrial cap rates have been among the lowest of all property types, even after the slowdown of 2022. And I said, what's going on here? Are we starting to see industrial start to level off? The person who I'm not at liberty to reveal kind of said, well, these things have an average remaining lease of 3 years. Cold storage can be a little bit flaky in that supply and demand can move differently than the rest of industrial. But it made me wonder if that 788 is now representative of where cold storage is, or if there's something more to it. So our listeners, if you have information on cold storage, you want to talk about this, let us know. Happy to talk more, but I was shocked we weren't seeing something in the fives. That was my second item of the week. And by the way, that story was from Commercial Observer. You could find it on their website. And then my last story comes from Atlanta. This is from Amy Wink of the Atlanta Business Chronicle. Americenter in that town sold for $81 million. B Group Capital was the buyer. The property totals 535,000 square feet. Why did this capture my attention? It captured my attention because the property last sold in 2015 for $90 million. So in this case, only a 10% discount to the value from 9 years ago. You know, we're talking about bright spots here and there. There have been very few in the office market at all recently. Most of the comps we see are 60% off, 50% off, 70% off. To see one that's only 10% off is a positive sign there. Happy to report that. So those are my three things that I saw this week. And by the way, Truist made a $62 million loan to allow B Group to buy that particular asset. So three things I was watching this week.
So that last story, Manus, bucks two generalizations that aren't really panning out. One is that you have to take a haircut to sell an office building, which wasn't the case. And the second is that no one's lending. Obviously, Truist Bank is willing to do that if the numbers make sense.
Let's move on to who's buying in this market.
So I caught a couple of stories. I mean, I could have put in 20 here, but nobody wants to listen to me for 2 hours. So here are three things that caught my attention in the who's buying. It takes us from Texas to Charlotte to Seattle. In Texas, Howard Hughes bought a building in the Woodlands for $19.2 million. Waterway Plaza 2 is in Woodlands, Texas at 10001 Woodlock Forest Drive. The sale represents $135 per square foot. Reporting there came from Cron, which is part of the Houston Chronicle. Why did I bring this story up? I brought it up only because Texas is a non-disclosure state. You don't see prices reported very often. It's hard for people to get transparency in that state. In this particular case, the Cron announced that this particular property, which was only 55% leased, by the way, sold for $135 a square foot. Not bad, considering that sometimes we're seeing properties sell for $40 a square foot in this market. Apparently, Howard Hughes believes that he could re-tenant that property and get it closer to 80 or 90%. So good on them. Elsewhere, Avison Young has arranged a sale of an industrial building in Charlotte, $97 million. This is a property multi-tenant, which totals 1.4 million square feet. It's at 1900 Continental Boulevard. Chris Skibinski, Chris Lloyd, and Eric Foster of Avison Young brokered that transaction. They say that this marks the largest industrial sale in that market this year, reporting from Real Estate Business Online. But there is a little cloud, if you ask me, over this particular sale, and it goes to my earlier remarks. Are we starting to see industrial level off? This sale was done at $69 a square foot. We've become very accustomed in recent years to seeing the square foot number for industrial go from 80 to 140 to 180 to mid 200s as this effusiveness industrial has taken root over the last 3 or 4 years. The price in this case, under $100 a square foot, which caught my attention. In Seattle, I think we probably need a 15-minute segment on Seattle. There's so much happening there right now. So much is selling, and so much is selling at sizable discounts. It probably is worthy of its own segment. But here, Roundhouse has bought a 17-story property in downtown for $76.3 million. That's a $20 million discount to where it traded 5 years ago. The property itself is a 209-unit high-rise at 1 Minor Avenue. The Puget Sound Business Journal first reported this. The seller was an affiliate of Iconics Capital. They're based in San Francisco. The sale works out to about $365K per unit. Iconic bought the property in 2019 for $96 million, so almost $460K per unit at the time. So that's a disappointing comp in the Seattle market. 3 or 4 other comps in that market came in the last 10 days, all pointing towards sizable double-digit discounts. So I guess I'm not surprised. In Seattle, we've seen big office give-backs of space from Microsoft, Amazon, and others. The big tech firms are downsizing there, so maybe between that and the quality of life issues that we've seen in Seattle, that is contributing to what we're seeing as big discounts there.
Yeah, you might be right. We could do a whole segment on Seattle alone. But it's interesting listening to these anecdotes, Manus, because a lot of the metros that you mentioned, Charlotte, Houston, Atlanta, are really driving a lot of the investment attention these days. And the metrics that we're watching here at Lightbox really reflect that. So now that mid-year is behind us and we're drilling deeper into the metrics that we'll present in our quarterly snapshot reports, 2 that I'm going to be watching closely are which are the high growth metros that are outperforming U.S. averages. And the second is one that I mentioned last week, which is the average number of non-disclosure agreements that we're seeing per listing in our Real Capital Markets platform. In Q1, that average number of NDAs was 99 per listing. It averaged, I believe, like 105 last year. So to use your phrase from earlier in this podcast, it'll be a measure of the extent to which the sharks are circling as they start hearing about these deals and thinking, look, I'm going to dip my toe in the water and see which properties are on the selling block. So at next week's podcast, I'll be able to share that average per listing and see if we beat 99 as kind of a sign that buyers are starting to look around and see what's what.
I'd love to see that number go back maybe 5 or 6 years if the RCM guys have it. And I'd love to see how 99 compares to the historical average. To me, 99 runs completely contrary to what some think, that there's only a couple buyers per property, that you're looking to find a needle in a haystack. You're trying to find the buyer of last resort. I think we're well beyond that point, even for properties that are really, really out of favor. So maybe in a future pod, we can go back and look at those numbers.
Agreed. We do have time series data. I can dig out what it was at. I'm curious to see how it compares to the peak of 2021 and even where we were in early 2022. And Manus, we have it by asset class. So we are able to see which asset classes are more in vogue than others.
My heart is racing already, Diane. I can't wait to see it.
So let's quickly move to who's lending. You mentioned Seattle. We've got another lending deal that takes us back to Seattle, and it's a complex deal that you wanted to walk through. And I think you got another one in just under the wire.
Yes, Martha, going back to Seattle, even though a lot of the stories have been negative, this one is more of a positive. In this particular case, SRM acquired a Seattle multifamily property for $84 million. This one got my attention because of a somewhat complex capital stack. Complex always sounds bad, but in this case, it's kind of interesting and good. A couple of years ago, Amazon created a housing fund that developers could tap into if they were going to keep a complex that they were buying permanently affordable. So in this particular case, SRM acquired the Mill at First Hill. It's a 358-unit property at 1008th Avenue. The sellers there were affiliates of Sequoia Equities. It works out to about $235,000 per unit, but Amazon Amazon kicked in $34 million of housing finance through their Amazon Housing Equity Fund. Other lenders stepped in as well. And what this allows is the complex in perpetuity to stay 100% affordable. So an interesting deal there. The reporting comes from The Real Deal in that case. Another one, the one that we're talking about that just came in under the wire, this comes from Commercial Observer. In this particular case, the writer there, Max Gross, the Kushner Companies, is developing a property at One Journal Square in Jersey City. They've been doing it for a while. They're about to kick off phase 2, and they've landed a nearly $300 million construction loan to allow this. The loan is made up of a $210 million senior piece that comes from Apollo. There's also an $85 million mezz loan from RXR, which will allow Kushner to move forward with a 1,700-unit apartment complex that also comes with retail and offices as well. So again, as Diane pointed out before, this idea that nobody's lending, not really true. Here, this is a spec deal. Kushner's coming in. He's going to have to execute on building this property, leasing it up, and so forth. And here you have Apollo and RXR stepping up with nearly $300 million of financing. So those are my construction deals for the week.
From a listener, we had someone who shared the Wall Street Journal story about Starwood Capital restricting investor withdrawals. They wanted our hot take on that story, and I know it's something we've talked about in the past.
Well, the withdrawal story has been out there for a while, for about 18 months. BREIT, the REIT that is run by Blackstone, that really caters towards retail investors. A lot of wealth fund managers have put private investors into this fund over years, or had been putting it in, attracted by the monthly dividend that was coming out that was substantially higher than treasuries. When interest rates start to peak up, that dividend didn't look nearly as attractive, and a lot of these wealth managers took their clients out of this in droves. And that led BREIT to really have to limit redemptions month after month. That's part of their prospectus, that they could cap redemptions so that they're not forced to sell into a illiquid market or a market where they think they're not getting great execution. They've been doing that for a long time. Starwood as well started doing that in 2023. They're doing it again now with their non-traded REIT. Their CEO, Barry Sternlicht, revealed that he really doesn't want to be selling into a market where he's a forced seller. He wants to get great execution. He's capped redemptions, again, which is his right to do. But the interesting thing there is, on the one hand, firms like Blackstone and Starwood are seeing people wanting their money back on the one side, and often that is the retail side of things. Yet with the left hand, what they're doing is raising money hand over fist to take advantage of what will be deep discounts in office and other property types as distressed asset holders, loan holders, or property owners look to sell things off. So it's kind of a nuanced story there. On the one hand, people want their money back, and Starwood and others are dealing with redemptions. On the other hand, they are raising money to have dry powder to put to work. So it's really two different stories in one here. So appreciate the reach out. Great question. And it leads me to another parenthetical here, which is, if you have a story or a question you'd like to come to us with, certainly send it our way. Or if you have a deal that you think was interesting because of the market it's in, the property type it's in, what got it over the finish line, we'd love to hear about it and talk about it. So don't be shy coming to us with things that you're seeing.
And a last story, Manus. I know this one's dedicated to you. The sale of the Lake Lure Inn in North Carolina, which of course was the site where the 1987 movie Dirty Dancing was filmed. It was sold.
Well, I was in my 20s when Dirty Dancing came out. I think I saw it in a movie theater. I remember thinking nobody's putting Manus in the corner after coming out with that. My question for you, Diane, and you, Martha, how many times after that movie came out did you run down the hallway of your home asking your friends to catch you on their arms to replicate that iconic scene with Patrick Swayze? Was that one time, 20 times, 100 times? And how did your friends do trying to catch you?
My answer is 0, but I did have a friend on the gymnastics team who did that routinely at our sleepover parties. So this news story really brings back memories. And I'll say that I was at a huge wedding on Sunday in Staten Island, and the parents of the bride got married in the place where Dirty Dancing was filmed. So this story brings the total number of Dirty Dancing mentions this week to 2.
Wow. Well, Manus, I do it at every wedding that I go to. So with great success, I'll say. Nobody puts baby in the corner. Thank you to Hannah Tebow, our producer. Please join us each week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send us your comments or questions to podcast@lightboxre.com. Thank you for listening and enjoy your long weekend.
Let's go.